Welcome. It is nice having you here. You know, here at Lions Wealth, our goal is to help you visualize kind of the aspects of your overall wealth plan. Now, yes, I know this can be, well, possibly boring at times, but I assure you that what we're talking about actually can be quite exciting, especially when it relates to the ongoings of the world and how that relates to changes in your portfolio. So we really want to be diving into some of those aspects today and making sure that you have, well, not only your questions answered, but you have a way forward for your wealth plan. So to get started, we're going to dive into economic and stock market risks. There has been a lot of data that has come out just in the last couple of days, and the US economy is at the heart of all of this. See, we had the fourth quarter GDP numbers that just came out, and they quote unquote exceeded expectations and really showed a robustness of 3.3% quarter over quarter, which was more than the 3.1 increase that they were expecting. So here's the thing though, when we talk about this, really what it is just a bunch of economists that were polled and they gave a number. Well, yes, we saw a huge increase in our GDP for the fourth quarter, but here's really what we're looking at. We keep talking here over the last couple of weeks about the fact that we are in a lead 4 stage, and this is where we are a slowing of growth and a slowing of inflation. Well, what this is really in contrast to is going forward versus looking backwards. And what we just saw is that yes, we had a great fourth quarter. Now going forward, things will change a little bit. So the acceleration that we saw, yes, it was a positive sign, but it's part of a larger picture that's going on with our economy right now. And in recent weeks, we've also seen many other elements like oil prices surge by almost 10%. So this is again going in contrast to some of the other elements that we're seeing, and it's directly related to some of the aspects of, well, some of the issues in the Red Sea, as well as some of the other, well, dynamics that are going on around the world. Because really, when it comes down to it, oil is a great indicator of where the world is going. And we've had this increase just because of the fact that we had cuts happening in Saudi Arabia and other members of the OPEC nations. So that's really an issue as well. So what can actually happen here is that oil prices going up could actually potentially drive our inflation numbers higher as we head towards the end of this quarter. So yes, right now we're predicting that we're going to have a deceleration of inflation, but that could easily reverse and start heading back up if we start to see oil prices go up. So that's a piece of it here, that it is a large part of our inflation, or the CPI, and oil itself could lead to significant inflation and a kind of revival of that whole, well, epidemic that we've been really having to struggle with over the course of the last couple of years. Well, when the CPI is hitting its lows around 2.97% year over year, any increase from here could actually be very impactful when it comes to energy prices on inflation. So that's just one element here. Now, oil is obviously there, but we're also keeping an eye on many other elements and indicators as well. Now, like I said before, that we're really monitoring inflation because we think it will and is coming down, but the global supply chain and all the pressures that we're having, the Case-Shiller Home Price Index, manufacturing costs, all of these things are showing signs of inflation starting to creep back in. Now that could be very worrisome with what's going on, but if the economy keeps chugging, this won't be a problem. But on the other hand, if it starts to decelerate the way that we are thinking it will, well, we may have some issues that are starting to creep up. So what you're seeing here is that this is not just something that is a one-off, but the Federal Reserve is really trying to figure this out. So they're trying to say, should we keep our interest rates at the same level, or should we start to cut interest rates? And that has been changing on a day-to-day basis. So while we thought that, and what was being really talked about, was possibly even a rate cut by March of this year, maybe postponed. So all of that is to say there's a lot of unknowns in the market, and we need to be aware of that as we look towards the future and not looking to the past. Number 2, portfolio changes. As we can see, there's a lot that's going on with our economy. Now, what we want to do is actually translate that, if we can, into a portfolio and changes that we can continually be making. Now, yes, we have talked a lot about the inflation and oil and all these different aspects. Well, that is okay when the economy is doing okay. But on the flip side, there's a lot of times that energy may not be the best place to be when we have hard times in our economy. So let's focus on something else and shift our focus to sectors that we know are resilient, both in good times and bad times. And that's where we can be taking a look no further than what we're talking about with not only the Red Sea, but other aspects of shipping. Now, we have talked in the past about container ships and oil tankers and how we are working with global trade. And these companies are crucial for us. We can be invested into them in the manner that will allow us to grow as they do. So that's one element that we can be working at and looking into with our portfolio. Now, there are other areas as well, and one that really has been doing a great job and one that we have been investing really well in has been healthcare related companies. And that is remaining really a priority for us right now. So when we take a look at healthcare, that's going to be something that we see working in not only good times and bad times of the economy. Because in the good times, everyone is wanting and needing to go to the doctor at times, and these healthcare companies can actually raise prices with inflation. In the poor times, these are also companies that are generally resilient because they can be changing the way that they structure billable pay and other elements so that their companies are taken care of while you're getting the care you need. So there's a really resilience to these types of companies, and one is really the reason why we want it as part of the portfolio. Now, there's other stability and growth potential that's out there as well, and that's why we're taking a look at India. We've been talking about India for probably about 6 months now, and it really is something that the Indian stock market is doing incredible. However, is that unlike the US, where there's been mixed economic data, unlike Europe that is in a full-blown recession, India has been increasing and growing their economy. And they are one of the few bright spots around the world. So the Indian stock market is actually something that's doing quite well, and one reason why we want to be looking to India more and more. So that's a lot of different aspects that we have been talking about already, and what we want to be continuing to focus on with respect to your positioning going forward. Now, the other element is that bonds have been a good place to be invested up until recently, and we're talking just the last couple days. Now, we're talking more long-term bonds, but the short-term bonds are doing quite well. And the short-term bonds are still providing some great dividends and interest, and something that we can potentially continue to keep being invested into for the safety aspect of them as well. So yes, they are not nearly as safe as, say, what a money market is, but they do provide some potential for growth, and they provide some potential for those dividends that continue to keep coming in month, out, quarter in, quarter out, and that's what we want them for. Number 3, wealth management and advanced planning. Let's take a moment and talk about how to maximize your investment potential. And I'm specifically talking about something that is unique to this time of year, your Roth IRAs. Now, what is so nice about Roth IRAs is that once the money is into these accounts, they grow tax-free. And then we can actually be using them in retirement potentially tax-free as well. So there's an incredible opportunity that we have here. And while you have working income, you can be placing money into Roth IRAs. So again, a fantastic opportunity. Now, here's the thing. What's unique about this time of year is that if you're taking a look at last year, 2023, we can still actually put away for 2023 Roth IRAs. And then we can be doing this and having them grow in a tax-free vehicle. Now, that's a really nice aspect here. What if you don't qualify to invest into a Roth IRA? Well, that's where we can actually be taking a look at other elements as well. And what we can be taking a look at is what we call the backdoor Roth IRA. Now, this is where we can be taking a look at some of the other investments you have inside your IRA. And there's a potential that we can be going into your traditional IRA that is not a tax-deductible contribution. But what that will do then is say then we could potentially be doing a Roth conversion without any tax consequences. So again, this is something that strategically makes sense, but only in certain elements, in certain ways. So as you have questions, feel free to reach out because we can be talking about if this will actually be appropriate for you to do. But this, if done correctly and we have everything taken care of, is something that is no real income barrier or income limit to it. So we can do contributions into your traditional IRA that are non-tax deductible, and then later we can do Roth conversions. So there's great elements to what we can be doing and being able to put money away for 2023 still today in tax-free potential vehicle. And that brings us to number 4, our second opinion service. As you can see, there are many elements when it comes to your overall wealth plan, and Roth IRAs are just a piece of it. But if done incorrectly, can actually be very hurtful and have negative impacts. That's why we have the second opinion service, to make sure that you, your family, your coworkers, the ones that you care about, are taken care of. You see, what we'll do is go through a series of questions in our discovery meeting to find out where you're at today. Then we are going to go through where you want to be in the future and see if any gaps exist. The next thing that we'll do then is talk about how to potentially fill those gaps to help improve your overall wealth plan. That is the value of our second opinion service, and one that we want to be not only extending to you, but to those you care about. So as you have questions or want to schedule, feel free to reach out and we'd be happy to have you. With our time today, there's been many elements that we've discussed. Now, like I said in our second opinion service, as you have questions, feel free to reach out, because right now, this is a very valuable time to be taking a look at your wealth plan and ensuring that we have the ability to help correct, grow, and potentially improve your wealth plan for the future. With that, take care.